Let's say you give your friend $10,000, but there's a strict condition attached to the cash. They must immediately spend it at your lemonade stand. At the end of the day, you check your ledger and you brag that your beverage business just made record revenue.
Everybody have a good week!
Your net worth triples overnight. That sounds like a childish accounting scam. But this exact mechanism is currently propping up a multi-trillion-dollar market. Wall Street calls it the circular money machine. Tech giants are executing unprecedented minority equity investments into frontier AI developers.
NVIDIA is going to invest an additional $2 billion into CoreWeave.
Meta has formed a $27 billion infrastructure agreement with AI cloud company Nebius.
OpenAI is teaming up with AMD in a partnership that could give Sam Altman's startup a 10% stake in the chipmaker virtually for free. Wall Street Journal is reporting that OpenAI has signed a $300 billion deal with Oracle.
There's some suspicions going around that this whole thing has become a kind of circular money machine, that the hunt for growth, the hunt for justifying share prices and investment and valuations.
In March 2026, OpenAI closed the largest private funding round in modern history. They raised a staggering $122 billion.
The breathtaking number, $122 billion, we've reported potentially on an entry to public markets at some point later this year.
Because these training runs, as they call them, to build the next AI model are now happening with greater and greater frequency. We're seeing new releases shift from a 6-month or 1-year cycle to every few months now. There's a new model from one of the major companies, and those cost a lot to produce.
The public viewed this as a traditional venture capital raise, but a closer look at the cap table reveals a different reality. This was a heavily concentrated vendor financing raise led by Amazon, Microsoft, and NVIDIA. Big tech companies are essentially funding their own customers to manufacture top-line revenue, and this legal loophole is creating a massive economic illusion. OpenAI's most recent round of $122 billion puts them at a post-money valuation of $852 billion. Now, the sheer scale of that number requires some serious context, because of that $122 billion, $110 billion came from 3 corporations. These are the strategic anchors. Amazon committed $50 billion, NVIDIA injected $30 billion, SoftBank deployed another $30 billion. This cash is fundamentally and legally intertwined with commercial vendor agreements. Take Amazon, for example. Their record-breaking equity commitment comes with a very highly specific structural catch. The deal legally obligates OpenAI to spend $100 billion on AWS cloud infrastructure.
OpenAI is teaming up with Amazon for the first time ever on compute in a deal that not only makes AWS the newest hyperscaler to power ChatGPT, but also consumes nearly all of the capital from the financing round that had just closed.
And this spending has to occur over an 8-year performance period. So Amazon is literally handing OpenAI venture capital money to guarantee future cloud revenue for themselves. They will recapture that entire sum plus an additional $50 billion. So this operates as a massively subsidized customer acquisition cost to Amazon, and it immediately locks OpenAI into the proprietary Amazon ecosystem. NVIDIA executes a very similar strategy with their $30 billion commitment. This money from NVIDIA would allow OpenAI to continue acquiring next-gen Blackwell supercomputers. It also ensures that the NVIDIA hardware manufacturing pipeline remains deeply backlogged with orders. And this is a really strategic way for them to shield data center revenue metrics from cyclical market downturns. Again, these massive technology conglomerates are basically and effectively prepaying for their own future revenue. They inject capital into an AI startup, and the AI startup then aggressively consumes those credits to lease compute power. The hyperscaler then recognizes top-line revenue on their income statement. So this reciprocal flow of funds basically transforms startup investing or venture risk into guaranteed cash, and it merges the roles of the equity investor, the hardware supplier, and the infrastructure landlord. The money simply spins in a very tight, closed corporate circle, but if the cash is just going back and forth and spinning, how is Wall Street legally allowing this? How do tech giants even report the circular movement as actual profit? The answer lies buried deep in corporate accounting standards, specifically under financial reporting standards called FASB, and the subsection is ASU 2016-01. Now, before this update, private investments were recorded pretty conservatively, which meant that companies would keep these assets on their books at historical cost. But with this update to the rule, it actually fundamentally changed the way that these companies report. This change allows tech companies to start carrying investments at fair value, which creates this opportunity or this loophole for manufacturing some paper earnings. So when OpenAI raises $122 billion at this round, putting them at an $852 billion post-money valuation, that new price tag then triggers an observable price change under GAAP rules. So Microsoft, Amazon, and SoftBank start aggressively marking up their existing shares, and then they mathematically reflect this new inflated valuation. The gain is immediately recognized on their corporate income statement, and it boosts income without generating a single dollar of actual cash. So let's look at a real undeniable case study. Microsoft currently holds a massive minority stake in OpenAI, which requires them to use the equity method of accounting to account for this investment. And what that means is that they have to record their proportional share of OpenAI's actual operational gains and losses. But OpenAI is operating at a loss right now. So because training foundational AI models is such an incredibly expensive endeavor, in the first quarter of 2026, Microsoft had to absorb a $3.1 billion operational loss as a result of their equity ownership in OpenAI. And this was basically a direct hit negatively to Microsoft's bottom line from OpenAI's cash burn.
One other interesting nugget here, guys, to talk about the OpenAI stake. That resulted in a $3 billion negative impact to net income. So the losses at OpenAI are starting to drag even more on Microsoft's net income.
Not a sweat though, Microsoft did not panic. They actually utilized a very highly technical mechanism known as a dilution gain. When OpenAI was originally founded, they were legally structured as a non-profit organization. They recently structured themselves into a public benefit corporation.
So the news in particular is that OpenAI successfully completed its restructuring. As you may know, the company had initially been founded as a nonprofit in 2015. 4 years later, it created a for-profit subsidiary so that it can take on some additional funding. And then last year, as part of its $6.6 billion fundraise and the current year's $41 billion fundraise, the company had promised investors and other shareholders that it would complete a corporate restructuring to turn into a public benefit corporation. That basically allows the company to be able to successfully go public if it chooses to and paves that path, or also continue to fundraise and have investors reap the returns that they seek to in a traditional way.
The restructuring alone not only triggered a huge media event, but also a massive recapitalization event. And Microsoft's ownership, because of this restructuring, actually went down. But because the overall valuation of OpenAI went up so much with this most recent raise, the net effect of Microsoft's ownership portion actually went up as well. So in Q1's 2026 filings, Microsoft actually recorded $5.9 billion in net gains, which went to other income and basically flow directly to the company's bottom line. So this paper gain as a result of OpenAI's restructuring completely offset the billions of dollars that OpenAI was reporting as an operational loss. You see how this all works? It basically is a perpetual self-reinforcing financial feedback loop. And when a hyperscaler issues an infrastructure investment to a startup, that startup again purchases cloud compute, generating immediately top-line revenue. The startup then raises more money at a massive premium to their prior raise, therefore increasing their post-money valuation every single raise, and then the hyperscaler books billions of dollars in non-operating paper earnings. And these executives of these companies are now using these inflated metrics to then justify even more infrastructure spending. So while all of this is in compliance and legal, it also creates a very perfect financial feedback loop that seems hard to break or seems kind of invincible until you look at what exactly happened 25 years ago.